How on earth were these founders I was talking with meant to cut through the noise and know what is going to be best for them at their stage of growth if the people advising them don't actually know what's right for their business? Now, I got off a call the other day with a couple of founders who've built an incredible business. They've driven most of their growth themselves from their social media presence. Now, they've already got a pretty successful business, but they're at the stage where they want to take the business to the next level. They were telling me their biggest problem was that they don't know what their next move should be. And I guess for context, probably like a lot of you out there, they're using their own cash to fund growth. So every penny matters. They explained that they need the biggest return possible early before worrying about smaller incremental tweaks. Now, I wasn't the first person they spoke to, and everybody's got an opinion. They've been told to pour money into ads to drive traffic. They've been told to focus on conversion rate. They've even been told to double down on retention and email. And you know what? None of that advice is wrong. But here's what really bothered me. Every single recommendation came from someone with a vested interest in selling in their own solution. Reminded me of that old saying, when you're a hammer, everything looks like a nail. Have you ever had it that if you speak to an ads agency, the solution always seems to be more ads? And if you speak to a conversion rate optimization agency, the answer is always more site tests. If you're dealing with a retention agency, the play is always more email. And the thing is, those might help, but they might not be the best move for you and your business at this point in time. And don't get me wrong, these things are all relevant and needed. And I've worked in agencies where we drove results from conversion rate optimization projects, retention campaigns, you name it. But here's the question I kept asking myself back then. Could we have done something better? Could the founders have made a smarter move with the same money? I don't know about you, but I got tired of the lack of transparency, tired of agencies pushing what they sell instead of what the brand really needs. So how on earth were these founders I was talking with meant to cut through the noise and know what is going to be best for them at their stage of growth if the people advising them don't actually know what's right for their business? That's the problem. And that's why, in this episode, I want to help you do something different. I want to show you how to make decisions based on what's actually going to move the needle for your business. Because the very real truth is, you can double your profit without doubling your effort if you put your money in the right places. And I'll prove it. Today, I'm going to break down the growth levers in your business and show you what happens when you improve them. You'll see how a small change in the right place can create a massive compounding effect. So if you've ever wondered where to put your money next, whether it's ads, conversion rate optimization, retention, or something else, stick with me. By the end of this, you'll know exactly which levers to pull first to get the biggest return. Today, I want to walk you through something I call the e-commerce growth cheat sheet. It's a simple way to see where to put your money and effort to get the biggest return. Because I know you can't invest in everything at once, but if you know which levers drive the most impact for your business, you can focus, invest, and scale. I'm Jason Chappell, founder of Defiant and creator of eCommerce Growth Made Easy. I help founders from startups to multi-million-dollar brands use this exact framework, and the results are game-changing. And don't worry if you're not staring at a spreadsheet with me right now. You can follow along with a notebook. I'll talk you through the numbers and keep it simple so you can run the same exercise after this episode. We're going to look at what happens if you improve all key levers, and then we'll break them down one by one to show you the revenue and profit impact of each, so you'll know exactly what's worth your focus and what's best left for another day. Before we get started, you can use the calculator I use in coaching on how to use it, as well as how you can leverage your own data to grow your business inside my eCommerce Growth Made Easy community on School. The link's in the description. So for today, here are the round numbers we'll use to make the maths easy, but feel free to use your own numbers here. I'm going to set my traffic levels at 100,000 visitors, my conversion rate at 3%, my total number of orders for the period at 8,600, my average order value at $100, my customer retention rate at 10%, and customers order 3 times a year on average. My customer acquisition cost is $45, and my gross margin is 60%. That's going to give us a total revenue of $860,000 and a profit of $277,000. Keep those numbers in mind as our baseline. Now, traffic is usually the first lever founders reach for, and it's easy to see why. you can literally increase your traffic overnight by putting more money into ads. If traffic goes up 20%, we go from 100,000 to 120,000 visitors. Assuming we keep conversion rate at the same level, that bumps revenue from 860,000 to over $1 million and adds over 120,000 in profit, taking it from 227,000 to just under 350,000. Sounds great, right? But here's the caveat. Traffic isn't always linear. The more you spend, the more people you reach beyond your core audience. And those new eyeballs might not convert as well, meaning your conversion rate could actually dip. That's what we call diminishing returns. So yes, traffic is quick and scalable, but it can get expensive fast if the rest of your business isn't optimized. Conversion rate is the next area for us to look at. Conversion rate is a multiplier that makes everything else work harder. A 20% lift here with my numbers means going from 3% to 3.6%. With our original traffic volume and repeat customer rate, that increase would take orders from 8,600 to over 10,300. Like an increase in traffic, revenue would go from 860,000 to just over 1 million, but profit would climb to over 405,000. Unlike traffic, you can't fix conversion with a single budget tweak. It's influenced by so many things like your messaging and branding, the copy in your ads and on your site, the audience you're targeting, the offers you're running, the landing page you send people to, the journey they go on after clicking, your product, your price, your reviews, even delivery costs and times. This is why I always say, conversion rate isn't just a website task. It's the sum of everything your customer experiences and sees. The upside, a better conversion rate compounds. It lowers your average customer acquisition cost because more of your traffic buys. And if you layer traffic growth on top, you're suddenly getting more juice from the squeeze. So just to be clear, conversion rate optimization is worth doing, but it's a long-term strategy and it never stands still. As the market changes, consumers' needs change, competitors make changes to their product, pricing and marketing. This can all impact your conversion rate. The next thing for us to look at is how many times someone orders from you, or orders per customer. This one's about frequency. Right now, in my example, we're saying customers buy on average 3 times a year, and a 20% increase pushes that to 3.6. Now, obviously, you can't place 0.6 of an order. This is an average across your whole customer base. So some will buy 4 times, and others only 3. But you get the idea. So here's the key. If you can get a portion of people to come back, even once more a year, it can have a huge effect. At 3.6 orders, revenue grows to just over $1 million and profit to around 370,000. Not as dramatic as traffic or conversion rate, but this lever matters because it keeps customers engaged. It's the foundation for long-term retention. So have a think if there's a way you can get customers to come back more often. Is there a product that you sell that complements something they've already bought? Or can you get someone to make their normal repeat purchase just 1 week earlier? That might give you an extra order per year. Anything you can do here will help increase this number. And remember, this isn't just about huge gains. We're looking for numbers that we can compound to get outsized returns. Next up is average order value. This is one of my favorites because it has such an immediate impact. A 20% bump in my numbers means average order value rises from $100 to $120. Now, let's just pause on that for a moment. Same traffic, same conversion rate, but each customer spending 20% more. That's huge. If we can achieve that, that pushes revenue to just over $1 million again, and profit to over 405,000. The beauty of average order value is that you only pay to acquire the customer once. And you pay this regardless of what they spend. So every single dollar you can get them to spend is almost pure contribution. And the best part, you can influence this almost immediately with bundles, upsells, free shipping thresholds. The list is endless. It's one of the easiest levers you can pull to increase profit without increasing costs. And you've already got the stock. So if you can sell through it faster, you're likely able to order more next time. And because you're ordering more, you have more leverage to negotiate a better price from your suppliers. So you could roll an average order value increase into a lower product cost. So not only are you taking more money and making more profit through not having to pay additional acquisition costs, you could also make savings on your cost of goods. I make that win, win, win. Next, if we look at customer retention, retention is a much slower burn. If your current retention rate, like in my example, is 10%, a 20% uplift takes you to 12%. That doesn't sound like much, but here's the thing. Whilst it may be slower, again, it compounds over time. I like to talk about retention like a pension. You don't see much in year one, but give it a few years and suddenly it's transformed into something much more substantial. Like they say, the best time to plant a tree was 20 years ago. The second best time is now. This is the same approach you need to take with your retention strategy. It won't fix next month's profit figures, but in time, it will build a base that lets you scale without drowning in acquisition costs. Now, let's flip things a bit and look at your acquisition costs. What if you could reduce your customer acquisition costs by 20%? In my example, this would take me from $45 down to $36. My revenue would stay the same at $860,000, but my profit would jump to over $370,000. And this is what a lot of founders, merchants, and ads agencies are trying to achieve. But here's the counterintuitive bit. Paying less isn't always better. Cheap customers are often cheap for a reason. More often than not, they don't come back, and they don't really spend very much. Ironically, often you're actually better off paying more for a high-value customer who sticks around and delivers over time with a high customer lifetime value. It might look expensive up front, but lifetime value makes it all worth it. It's the key to being able to weather any storms for volatile ad costs or rising acquisition costs. It also allows you to affordably outspend your competitors, leaving them wondering how you can afford to spend so much, leaving the lower value customers for them. It also gets you off the hamster wheel of fighting for those low value customers. The only caveat for higher acquisition costs is that you'll need a solid retention strategy to make this work long term. So to recap, lowering your customer acquisition costs is great, but only if the quality of the customer is the same. Now, just let that sit for a minute. Lower customer acquisition costs are great, but only if the quality of the customer stays the same. If you're not getting the same customer lifetime value from a cheaper customer, that's a clear indicator that you need to spend more, not less. Finally, let's look at improving your gross margin. In my example, I had a gross margin of 60%. If I improved that by 20%, it would go from 60 to 72%. This is easier said than done, but if you can do anything here, you'll see profits skyrocket to over $480,000 without seeing any change in your revenue. This lever often gets overlooked, but if you can renegotiate with suppliers, streamline fulfillment, or adjust pricing, it's one of the most powerful moves you can make. It might be something as simple as being able to increase your order volumes to get better unit prices because you're selling more stock through bundles or the work you're doing on average order value. You might even find that your warehousing fees are less than you think, and ordering more product and storing it yourself give you a greater margin per unit than ordering in smaller volumes. Whatever you can do here is worth looking into. Now, let's talk about what happens when we pull a couple of levers together. If everything improves by 20%, traffic, conversion rate, average order value, retention, customer acquisition cost, margin, in my example, we jumped from $860,000 in revenue and $267,000 in profit to over $1.8 million in revenue and more than $1.1 million in profit. That is transformational. But it's also unlikely you'll nail every metric at once. So let's look at a more realistic example. Let's say you improve just traffic and average order value by 20% each. Traffic alone takes revenue past 1 million and profit to just under 350,000. Average order value alone also takes revenue past 1 million, but pushes profit higher to over 405,000. But when we combine them, revenue shoots past 1.2 million with profit at over 480,000. That's the compounding effect. Two levers pulled together, delivering more than the sum of their parts. And the best part? These are two levers you can pull immediately. Increase ad spend to scale traffic whilst maintaining performance as best you can, and use bundles or upsells to lift average order value. You can literally act on this today. It doesn't even have to be these two numbers. If you feel you can improve other areas of your business, go for it. You've got to pick what's right for you. So here's your action for today. Grab a notebook and run this for your own numbers. Ask yourself, what happens if I improve traffic by 20%? What about average order value? What if I get even a tiny lift in conversion or retention? Write it down, do the maths, and you'll see exactly where to put your energy and your cash for the biggest payoff. And if you want the calculator that does all this for you, plus training and support to put it into practice, that's all inside my school community, eCommerce Growth Made Easy. The link's in the description, and it's free to get started. So go run your numbers, choose your levers, and see just how big the compound effect could be for you. I'll see you in the next one.